We've talked before about this idea of the four crises of 2022-2023. Today, I want to talk about the fourth crisis. Just to think back on it, the first crisis has been the crypto winter that set in 2022-2023, and we've seen this largely resolved with, I think, now a clear direction in terms of regulatory path forward. Our second crisis was the tech bank trauma in the United States in the early part of 2023, triggered by, in particular, the failure of Signature Bank, leading into the failure of SVB, Silicon Valley Bank, and some of the most rapid tech-enabled bank runs and bank collapses which we've ever seen. That crisis is leading to an increased use of RegTech, regulatory technology, both in banking sector, but also from the standpoint of regulators. It's also very much triggered a move towards deposits in ever larger banks where the risks are lower, and also a move into money market mutual funds in order to gain both liquidity but also higher levels of return. That has also triggered a real loss from the standpoint of venture capital and early stage tech financing, which we've previously discussed. Our third crisis was the failure of Credit Suisse. And the failure of Credit Suisse was something quite different. It was triggered by a long period of business problems in the context of Credit Suisse, a series of issues triggered by the crypto winter, the tech bank trauma, which eventually fed through to a loss of confidence and large-scale withdrawals, particularly of asset management customers from Credit Suisse. And if we think about the Credit Suisse failure, the big things going forward, once again, greater use of RegTech by financial institutions, a greater use of RegTech by regulators, but also an adjustment in the context of how capital and liquidity requirements, and from the standpoint of supervisors, how planning purposes work in the context of potential failures of systemically important financial institutions. Now, if we think about the fourth crisis is something that's a little bit different from those other three. It's not so much linked to technology, which linked our first two crises together. Rather, it's linked to the piece that really tied all four of our crises together, and that has been a string of interest rate increases coming out of major central banks over the past several years. And this increase in interest rates is feeding through to higher costs of repayment of the debts of particularly poor developing countries. And this is something that if you combine it with the impact of COVID, particularly from the standpoint of tourism, you combine it with the Russia-Ukraine war and its impact on energy prices and agricultural products, the end result has been a confluence of factors which are having a terrible impact on a significant number of the world's poorest countries. Now, in some ways, this idea of countries which have borrowed money, which then as a result of economic changes, particularly commodity shocks from a variety of different sources, higher interest rates, all of these factors we've seen many times before in earlier cycles of emerging sovereign debt crises. Perhaps what is different this time are two things. One has been the increase in involvement of a new type of creditor. In addition to our traditional developed country lenders, in addition to bond markets, in addition to multilateral financial institutions, and in addition to a variety of private financial institutions, all of whom have loaned money to developing countries over extended periods of time, we've seen two new types of lenders emerge. And the first has been the emergence of China as one of the world's major creditor countries. The second has been an impact of the development of domestic currency bond markets, which means that we also have very large volumes in many cases of domestic bond debt, which has been sold to domestic investors. This combination of economic aspects, financial aspects, and a multitude of different creditors, lenders, and investors is making the resolution of this crisis more difficult. And this is something that, as we look at the resolution of crises in Zambia or Sri Lanka, the key is to differentiate between purely sovereign country-to-country debt, whether that is developed country debt or it is to China or India or an emerging range of non-traditional sovereign creditors, with credit that is coming from multilateral institutions such as the World Bank, with credit which is coming from a variety of commercial institutions, regardless of the ownership structure of those commercial institutions. But the fact that really makes the fourth crisis different from what we've seen in previous emerging markets crises is what we are seeing from the standpoint of climate change. If we look at many of these countries, not only are they having economic issues, governance issues, problems as a result of commodities, food supply, creditor problems, but in fact, natural disasters, climate change issues are worsening all of these problems, and in many cases, making their resolution, and in particular, a return to some level of stability and development, almost impossible. And as I think we move into what is likely to be one of the hottest summers on record in the Northern Hemisphere, we're likely to see an increased acceleration in traumas, natural disasters, deaths, coming out of this combination of financial problems and climate issues. And going forward, this fourth crisis is going to be the hardest of all of these crises to figure out how to solve.